fundsupermart.com.
What is your outlook for the US equity market going forward?
Well, as a house, we continue to hold on our view that the US market is a positive long-term market based on one very simple macro trend because we see improvement in the US economy in the next couple of years to come. You see, if you do look at the US market, after a weaker start to the year, where you can see so-called quarter-on-quarter annualized GDP is minus 2.9%, due to the very bad so-called winter season in the US in the first quarter. Lately, if you look at the economic data releases, we have seen an improvement in the housing market as well as in the labor market. So this will continue to be supportive for the market. If you do look at the unemployment rate is at 6.1%, based on the latest number. And also you look at the net annual, the payroll per month is 250,000. So that continued to be one of the strongest numbers that we have seen in the last so-called 6 years. And again, the only segment that is not improving is the corporate investment. But we do expect this segment to slowly pick up in the coming quarters. So overall, when you look at the market per se, we expect the US market to continue to perform well under this environment, where the growth is not so strong that you can push for an inflationary environment so-called situation. But overall, I think things are still pretty much on track for the equity market performance, which is a positive one in the coming years, in our view.
What will be the drivers and detractors to performance over the coming years?
Well, the key drivers, like I mentioned just now, to the market performance for the US market is coming from the secular improvement in terms of the growth outlook. So for the next 2 years to come, we expect growth to be better than what we have seen in the last couple of years. So with improving growth outlook, we definitely will see consumer spending to go up, and that will be supported by the improvement in the labor market condition. And then with the improvement in terms of the consumer spending, we will in turn see corporate management confidence in business prospect to improve, and that will lead them to spend a bit more in terms of capex and hiring. So all in, that could be be very supportive of the US so-called equity market. So the main detractor in our view will be the eventual normalization of the Federal Reserve monetary policy. Because eventually when growth is strong, they need to actually wind down in terms of the accommodative monetary policy. But if that comes with an environment of where the growth is still strong, that is still be an okay outcome, and that will be an outcome that we think is favorable to the equity market. But however, I think one thing we need to note is the environment of cheap and supercharged liquidity is behind us. So the strongest period of stock market gains, again, will be behind us as well.
What are your views on the Fed tapering, and how would these issues affect investments in US equities?
On Fed tapering, we have been telling our clients since the end of last year that it will be a gradual process. And so far, after 5 meetings, it has been the case. So really, I think if you look at the equity market performance for the US market, despite the tapering, the market continued to perform quite well since the end of last year. So we don't think that the Fed tapering will have a major impact on the US equity market. But what is more important from here is the Fed will continue to monitor the tapering process and also the economic conditions. So when it comes to tapering, we expect the Federal Reserve to end the tapering somewhere in October this year. And from there, they will need to pause for a couple of quarters for them to monitor the economic condition before to decide when to raise interest rate. And our view on that is the Federal Reserve will only raise interest rate sometime in the middle of next year or towards the second half of next year. So what you don't want to see from here till the second half of next year is inflation to pick up in a very fast manner. Then that might force the Fed to actually raise interest rate faster than expected. So when that happens, it could be a bad thing for equity market, because we do expect the market to be caught off guard by this so-called sudden tightening of the Federal Reserve. And not only the equity market, but we think the bond market will experience a sell-off as well.
Within US, what are the sectors or industries that are expected to outperform?
Broadly speaking, we like sectors or industry that are geared towards the economic recovery in the US, like what we talked about just now. The three sectors that we like, if you were to put it in a very macro perspective, we like so-called the IT sector because we think the trend will be secular and the enterprise spending will increase. The other sector that we like will be the financial, because generally financial sector tend to perform better in line of the recovery in the economy. The other sector that we like is the consumer discretionary, because like I mentioned just now, with improving employment gain, healthier balance sheet for the private sector after the deleveraging in the last couple of years, and also the increase in the real disposable income will benefit the consumer sector in general.
Conversely, what are the sectors or industries that you have the least conviction in?
Again, broadly speaking, we definitely remain very cautious on those sector or industry that are not geared to economic recovery. And what is worse is if they are very vulnerable on the rising interest rate environment. Okay, and that will be very bad if those sectors or industry comes with a very stretched balance sheet. So from all these perspectives, the three sectors that we remain cautious on, the first one will be utilities. Why utilities? Because we think the growth will be stagnant or to declining trend, the way we look at it, and also it will come with a tighter environmental regulation from the US government. The other sector we don't really like would be those in the telco sector, because we think the telco sector is fairly saturated and the competition is very fierce among the players. Okay, so the last sector that we don't like, if you name three sectors, would be those in the material so-called segment, because we think that the oversupply are in many areas of that sectors. So under such environment, I think one needs to be very selective in terms of their sector and the stock picking to be able to outperform the general market under such environment. Thank you.